Thanks for tuning into today's Talking Point. I'm your host, Neeraj Shah. Our guest today, Dinshaw Irani of Helios Mutual Fund. Dinshaw, great having you. Thanks for taking the time out.
Thank you, Neeraj, for having me on your show, and a very good morning to you and your viewers.
Thank you so much. You reckon we'll be blessed with more good mornings as the course of the year winds down, because there seem to be a lot of moving parts impacting these mornings these days.
Yeah, actually, Neeraj, the good part is that the goods are overpowering the bad today. So that is the good part. And frankly, if you look at the markets, though they've risen like 12 odd percent year to date, even 1 year basis, if you look at it, I think we are up 17. I'm talking about the broader index as such. But the fact is that these highs have been achieved after the re-ratings have happened. I mean, as in after every single quarter, you've seen that the earnings upgrades have happened. And as a result, the valuations are very much supporting these levels that the markets have achieved. So that is what where the comfort that we take away from here. And secondly, I mean, the flows wise also, you've seen that domestics have been constantly there to support. In fact, September again, there was a lot of selling by the FIIs and domestics were supporting it. In fact, bought more than what the FIIs have sold. So obviously that comfort also comes along with that the fact is that there's enough support, the valuations are good. So I think we're in a really sweet spot. So in the interim, in a very short term, there may be some kind of I think choppiness in the market, given that quite a few state elections are around the corner and stuff. And so that's why. But overall, I think we are in a very sweet spot.
A couple of global factors. I mean, the higher for longer necessarily is, you could argue, negative for all EMs, including India. And the news flow in the last 24 hours about the possibility of China giving a stimulus, which might make global investors, which have hitherto shunned China since March, maybe take a fresh look. And that might impact the flows from most other large EMs, including India, because there might be a move towards China. Now, do you reckon that could be a short-term negative?
So yeah, Neeraj, as I said, that short term we're looking at some choppiness. But anyway, higher for longer that you mentioned, I think that is where the bigger concern is. But the fact is that they've done an excellent job. I mean, I'm not an expert to comment on the US economy as such, but they've done a very good job in the sense that they've managed it very well thus far. If you look at the last 8 episodes when the inversions happened, invariably, I think the average time period after the decision coming in was 350 days or something at that point in time. And it hasn't happened thus far. So I don't see that happening. Plus, the unemployment rate is slowly creeping up in the US. That's a good point positive point for them to take away as such, which, I mean, ideally should be bad, but the fact is that they want that happening in a very smooth manner. So that is a good thing to look at. So I don't think that is going to be a very big overhang for a longer time. I mean, obviously, in the short period, there will be some problems. Secondly, you talked about China's stimulus. I think China's stimulus was around the corner because they've tried everything. They tried cutting interest rates, didn't work. And today, in fact, again, Evergrande, I mean, rather, not Evergrande, but Garden, one other real estate firm.
Country Garden.
Yeah, Country Garden. They've said that they're defaulting on their payments of debt. So obviously, the problems there are much more deeper than what comes out. In fact, someone just shared the demographic data of China, and it was obvious that the dividend that they were earning out of that demographics is gone. I mean, it's gone for real good because, I mean, someone told me that the birth rates last year were equal to what they saw in the lowest ever they saw since 1949. So obviously there's a huge problem coming up there, and I'm sure the world is cognizant of that fact. The fact is that China giving a stimulus again will be a very short-term kind of you may see some kind of flows on the very short-term side, but the fact is that India is probably the only economy after China which is going to give you that kind of growth impetus going forward. So obviously that cannot be ignored, and plus manufacturing is what we are opening up. So probably we are where China was in 2000 as such, and you know what happened to China after that. So.
Yeah. Interestingly, I mean, today, for example, that CLSA global team put out that India overweight position. A few other banks have done that too. So that is being recognized. IMF saying 6.3 is no mean feat. Dinshaw, just one quick thought here. Yesterday, I was talking to N. Jayakumar, and he was making this point that traditionally we've looked at FI overweight and FI favorite stocks driving the market and being the favorites. We've seen quite a turnaround or volte-face, if you will, in that aspect. Now, my question to you is, if that were to stay true, would you believe the nature of the winners, if the market stays stable, but there are a set of winners, then would the nature of the winners be largely concentrated towards what the domestics are favoring?
Neeraj, actually, that's a very good point you've raised. And actually, that is the truth. Because, I mean, as I said, that last month again, the FIs were sellers and domestics were buyers. So despite that, the market didn't do much. And the fact is that even if you look at the last calendar year, the FI has sold some $20 billion worth and the domestics about $26 billion worth. So you know whose side you need to be on, right? Where the buying is much more. So obviously the domestics are now driving the market. And frankly, I mean, it's a very good point for the FIIs also, because they know that there's this huge base which is ready to take up the slack if they ever want the money out of the country as such. So that also gives a lot of comfort to FIIs per se. So obviously it is quite given that I think it's the domestics which are going to drive the market going forward. And that's a very healthy sign to do. As I said, the $2 billion of SIPs on a monthly basis is not a small mean feat at all. And the fact is that if you add the NPSs and EPFOs and probably the insurance, unit-linked insurance schemes, it'll add up to something like $2.5 to $3 billion of monthly flows on a regular basis. That's really a very good base to be in as such. So I think you're right. I mean, domestics are going to be driving the index from here on.
You've in the last conversation with us and otherwise, you've spoken at length about how you, for example, prefer or lean towards the manufacturing end in a meaningful way. Now, my question to you is, some of that manufacturing-led themes have actually done really well. Maybe valuations are a bit stretched in some pockets too. And then there is a clutch of manufacturing-led themes, read Spec Chem, read maybe even select pharmaceuticals, wherein the valuations are a lot more promising and the commentary is turning at the margin. So my question to you is, when you look at allocating fresh capital to manufacturing, as you will with your NFOs coming up, etc., what end of manufacturing would you prefer to put in fresh capital to work?
So, okay, Neeraj, actually, if you look at the Forbes rich list, right? The bulk of the guys who come in that rich list are either from finance field or from consumption field or from tech, right? These are three majors which take away the chunk. So obviously, when we do develop the portfolio, you'll see a bulk of the overweight being in these sectors, right?
Okay.
And manufacturing also obviously will take a place in this in our portfolio, but it will be limited to the extent of the capex cycle, because you've seen that the last 3 capex cycles have been postponed for one reason or the other, and obviously the private capex, which is yet to pick up, and hats off to the government, they've been managing that slack for a while, but I think the private capex has to kick in now. So there'll be these kind of stocks which will be driven more by capex rather than manufacturing per se. Obviously, manufacturing will be limited to the PLI part of the business, where you know that outsourcing will play a big part going forward for the economy in India as such. So obviously, you will be looking at those kind of plays also coming in. Specifically on pharma, I think the problem in pharma is that the US is still not stabilized. I mean, though there was some stocks replenishment which happened, and that saw the prices moving up. But despite that, we've seen a lot of pressure in the US on generic space. And I think our analysts are quite clear that they will be not looking at the exporters per se, but they would rather look at the domestic players who are thick in the domestic market. So I think that's where we are in the pharma space.
Okay. So I stand corrected, and excuse me for that, Dinshaw. Let me then try and probe about financials, because here, the traditional favorites, despite the fact that there's a lot of promise on valuation, are not quite performing for the last 12 months. Read private banks. Some PSU banks have done well, very well for you guys, but you have to admit that CY23, some of those large PSU banks, SBI, etc., haven't quite really performed. Now, where is it and why is it that you believe some of these financials will do well?
So, as I said, Neeraj, the biggest growth stories in a growing economy are two sectors, right? They're basically financials and consumption, because these are the ones that drive the GDP, right? Financials is a double whammy because they don't only fund the consumption, but they also fund the capex, which is needed to take care of that consumption as it grows, right? So, coming back to what's happening right now in our space, in the financial space, the biggest, I think, pushback was that the NIMs have, the net interest margins rather, have peaked out, and we'll see a compression going forward and things like that, right? Which is not healthy for the industry, because obviously your interest rate cycle has peaked, and it's a matter of time before the deposits also start. You start paying more for your deposits. The banks start paying more for the deposits. So obviously the NIMs will look at compressing. But the bigger story, I think, which everybody missed out, was that the credit growth, which was fairly lagging, is now picking up. In fact, the last 2 quarters one has seen, and in fact this quarter again, one will see that the credit growth is in a very healthy space. Like we're talking about mid to late teens kind of on a system-wide basis. We're talking about mid to late teens kind of growth in credit space. So that, I think, is the bigger story here. And frankly, I mean, normally re-ratings happen when the actual businesses pick up rather than the margins improve going forward, right? So that is what's happening in this case. The actual re-rating is yet to happen. In fact, some of the banks have seen their price to books coming off basically because of this reason. And now that the credit growths pick up, you'll see that that is also picking up in a way. So that should be a healthy part. And we stick to our financials. In fact, I believe that going forward, it'll be the bank space, rather the private bank space, which will really pull away the index for all.
Okay, well, that wait has been rather long. One hope that it does fructify, Dinshaw. So that is part one. Part two on consumption. Last night, or rather early morning, there was a Bloomberg story about India considering a large impetus for farmers ahead of the elections as well. Now, my question to you is, hitherto, the K-shaped consumption theme has seen the upper end of the K work beautifully in terms of numbers. Is it time for the next 6 months to 9 months, both tactically and maybe valuation-wise, for the staples to perform? Or would you still be, or are you in the camp of the discretionary upper crust consumption continuing to rule over staples?
So the push to the rural economy was expected, not only because of the elections, the central elections being around the corner, but also the fact that it's a bit stressed right now. I mean, you can make out from the employment figures which come out, non-farm employment has gone down and agri employment has moved up, which is not healthy for the rural economy, because the bulk of the spends come when the non-farm incomes move up, right? So that is where the concern arises. And I think the government is doing the right thing by giving impetus to that particular sector. But given the fact that that kind of expenses will only go towards staples, we're still not too kicked about that segment per se, because look at the valuations, right? I mean, if you are trying to pay 60, 70 times forward earnings for growth rates of 11, 12%, I don't think that's justified. In the longer term, there may be a short blip or so, but in the longer term, they'll definitely underperform. So we're not too kicked on that side of the market. However, coming back to consumption, I mean, discretionary is the space you want to be in, because if you're talking about your per capita GDP moving up, and fortunately it will, because you've grown, your normal GDP is going to grow probably at 11 odd percent going forward. And obviously the population is going to keep pace. Hopefully not. I hope it's not going to happen that way. But obviously the per capita GDPs are going to blow up, right? So when that happens, it's the discretionary space which is the biggest beneficiary. So in the medium to long term, these are the guys you want to be with, and you're going to play the growth story here.
Okay, so here's the question about last 3 months, Dinshaw. I'll take 2 more questions and then we'll relieve you. The last 2-3 months, I've heard very promising stories, if you will, of a luxury car dealer, of a watchmaker, of a hotel company, all extremely luxury upper crust consumption being a multi-year story and not just a one-year phenomenon. I would love to understand if you believe in the same.
So, Neeraj, I mean, this was a global phenomenon, right? It's only, related to relegated to India, right? Globally, I mean, in fact, when we started looking at this theme, I remember in the middle of, April of 22, we were quite shaken by the fact that all global watch manufacturers, luxury watch manufacturers, you're talking about the Rolexes and Piagets of the world, they were running out of stock, right?
Right.
In fact, I still remember Hermes has this bag which is like $500,000, and there's a 1 year waiting for that kind of a bag, right? So it was obvious that this thing has to trickle to India too, but we don't have a super luxury out here because obviously that kind of luxury can appeal to only a fraction of the population in our country as such. So, but still we knew that like aspirational luxury, because as you start earning more, you aspire to own more, right? So that's why real estate was one sector that we looked at. I think hotels was another sector we looked at. Textiles was rather not textiles, but this thing is what we looked at. The manufacturers for garments and all that. So that is what we looked at. Shoes is what we looked at and stuff. So obviously these were the ones which were really appealing to us per se, and that helped in a way. So we stick to that. But frankly, I mean, even on the valuation side, there have been some stretches here. So we've been, at some point, we did chop off a bit of our ownership. But as and when the corrections came in, we still did build in a bit more in that. So we stick to that space, but we're very cognizant of valuations here.
Got it. Okay. My final question. IT is just completely fallen out of conversation, out of favor. Maybe the numbers are also not looking good right now. The one or two people who talk about IT tell me that they believe, there's a Nomura note today which spoke about how FY25 growth rates could actually move up to 8.2, 8.5% from 3.5 in FY24. Now, my question is, the people who believe in IT say that there is a possibility that the valuation bottoms might be reached somewhere around November, December, wherein companies start talking about FY25 and investors start thinking about FY25. How are you thinking about IT?
So, Neeraj, I think if you're talking about higher for longer, obviously there's a lot of uncertainty in the US that we're talking about, right? And discretionary normally takes a back seat here. In fact, I think the eye-opener was the Accenture results, which came out recently when they came up and they said that, okay, guys, the growth rates are down. We're looking at a lot of upheaval in the discretionary space as such. And obviously that, I think, was what the markets took away as a longer-term trend for IT per se. We don't think FY25 will be a year when most of the companies will come back and say, hey, we're going to start again with our discretionary spends. It's not going to happen. I think they'll wait for some kind of semblance from, rather indication from Fed, telling them, look, guys, I mean, this is enough. We're going to cut our rates. In fact, Fed is still threatening for one more hike in this quarter itself. And obviously, when the unemployment rates are moving up, you will not be seen outsourcing your spend as such. So obviously, there's a lot of question marks there. I don't see the world coming back, in vengeance to IT outsourcing per se. So I think FY24 is obviously a given that it's going to be a low growth year. Our feel is that even fiscal 25 will be a low growth year. It's only at the end of 25 when you'll start hearing companies talking about their budgets for 26, CY26 I'm talking about. And I think that's when you'll probably see some kind of semblance coming back into play as such. So it's a total no-no as of now for us.
Got it. Okay. We'll leave it at that. Thank you so much, Dinshaw, for taking the time out and speaking to us. Lovely talking to you as always.
Always a pleasure, Neeraj. Thank you.
Thank you. And viewers, thanks for tuning in.